Welcome everybody to our Q&A. Let me minimize that.
Special edition Q&A.
Special edition, the election Q&A. We've been promised this for a while, and it looks like there's some folks that have some interest, so I'm excited to actually go into this. You've probably seen some of the news that we're expecting actually end of this quarter, probably next week, to see a report of Q3 GDP that's going to show 33, 34, 35% increase, which is basically a V. It has, however, slowed down in the last few weeks, excuse me. That increase has slowed down, and I've heard it described as a slump, a bounce, a crawl, and then a surge. And the surge is something that happens, ultimately when we have a vaccine in place. So we're sort of entering that crawl space, and until we have a vaccine, we're going to crawl. We've pretty much gotten all the benefit we have out of the big bounce off the bottom, and now it's a matter of just working through. And I want to just start with that before we dig into the special edition election Q&A. And before I launch into any deeper, Scott or David or John, do any of you have anything you want to add to make sure we cover?
I mean, now that everyone's on, I just want to make sure that we remind everybody on the call that our country is super important. We love the United States like everybody else, but there's a whole world out there that's buzzing and doing its thing, and we're global investors, and we'll get into that a little bit later. But definitely wanted to, we're not just about the United States at Mindful Money. There's a whole world of global investing that we do. Very important.
Yeah, we're gonna talk specifically about, so we can actually just go into this. We can talk about what we're gonna talk about. So we see this Mindful Money Monthly Special Edition Election Q&A. Please, if anyone has a question, you can pop into the chat bar. You can also, I believe, you might be able to raise your hands and we can call on you verbally as well. I think that functionality is here. But by all means, if you have a question, pop it into chat. We're just gonna go through, I've got about 17 slides to kind of go through. They're in 3 basic sections. We're going to talk about market returns in election years. We're going to talk about some policy shifts. We're going to talk about other variables that I think are actually more important than what happens with the election in terms of markets and economies. And so we're going to start with this market returns in election years. So just really quick, we're going to see in a couple of data points that it's difficult to identify systematic return patterns in election years. There doesn't seem to be a lot of predictability. Whether it's an election year or not an election year, markets are usually positive. So we have this expectation that returns are going to be positive, and they are, 3/4 of the time. And market expectations that are associated with election outcomes, they're already there. Like all the people that think that Trump's going to get reelected, they're already betting on that in their investments. All the people that think that Biden is going to win, they're already making that bet in their investments. In other words, they've already adapted their portfolios to all of the prevailing information before we go into the actual election. And then the election will give us either a surprise or will give us what we expect. And then immediately afterwards, there'll be changes in portfolios to that results. So Scott, I think this is the one you wanted to make sure we had in here. Basically what this says is this is 1928 to present. Over the long term, this thing just goes up. It doesn't really care. And there's looking at this, you can tell it doesn't really care when a Republican is president or when a Democrat's president. There's a couple points in time where the Republicans as president does poorly. But the question is, what's going on at those times? And we're going to talk about that in just 1 second. And we're going to granularly, here is a monthly return chart, 1926 to 2019. This is a histogram. That black line between 0, -1 and 0 and +1, that's the 0 line. So to the right of that black line are all the times when the markets were positive. To the left is all the times when markets were negative. To the right in the blue is all the times when the markets were positive and a Democrat won a presidential election. to the right, and the red is all the times when the markets are positive and a Republican wins the election. The thing you can quickly look at or quickly see here, I hope, is that there's nothing predictable about this. It's all over the map. There's, I think what is 1, 2, 3, 4, there's 5 Democrats to the left, and there's 4 Republicans to the left. There are 1, 2, 3, 4, 5, 6, 7 Democrats to the right, and I believe there's also, looks like 7 Republicans to the right. So it's very evenly distributed. There isn't a way to use this information as a predictive about what might happen next. And so then we go in and look at the 3 markets that are our core portfolios. You know, the first core market is the S&P. Then we talk about international. Then we talk about emerging. We're going to look at in gray in all three scenarios. We're going to look at the average return during an election year, and then we're going to look at in green the return the year after the election. And you can see here in the United States, you know, going back to Hoover versus Smith in 1928. The average return during election years is actually a little bit higher than the average return in the subsequent election year. Okay, and there's a couple big outstanding things here, and one of them is, you know, 1936. You saw really big, sorry, 1932 and 1936. You see really big swings up, really big swings down. You know, what was that related to? Anyone want to take a guess as to why there's big ups and big downs in that period? You can unmute yourselves if you'd like.
The Depression.
Correct. Thank you. Now, anyone know why 2008 we have this big downswing? 2008.
The Great Recession.
Yeah. Thanks, Frank. It's really, it's not a function of who is president. It's almost always a function of other things going on. And in the Depression, it was, you know, Roosevelt was there. In the Great Recession, it was, you know, it was actually, you know, just post Bush, Obama was there. One couldn't have predicted these things. It was a thing that came out of left field to hit us that had nothing to do with who was running the country at the time. I mean, I think that whole phrase, running the country, is really, that's not how things work. We have someone that's a president, they don't really run the country. And when you look internationally, you see that those things, you know, as Scott was speaking to, internationally, those things kind of have the same kind of effect. 2008, it had nothing to do with, you know, what happens in the EFA index, which is the developed world outside of the United States, in 2008 had the same effect, has nothing to do with who's president, right? It's just markets reacting to the things that happen in the economy. Same in emerging markets. And where you see a lot of difference between the pre-election year and the post-election year, part of that is because there's fewer items here, and the one massive decline that happened in the pre-election year in 2008 overwhelms the gains in those pre-election year, or during those election years. And this is the fixed income market. Now, we're going to talk a little bit more about this in a second, because I actually think this is where the current problems for portfolios have way more to do with this than anything else. And as we get into some of the later slides here, we'll talk about that. So this is, you know, this is the long-term average here. So how should we approach investing in an election year? Now, in an election year, the average return is 5.8%. And this is between 1932 and 2019, data as of the end of August. The average, and I think, sorry, you can't see this, the average return in a non-election year in that same time frame was about 9.6%. Now, on the right side, you see volatility. So you see, looking at the return versus the volatility, yes, you see that in an election year, you're going to see more volatility than an average year, and you're going to see slightly lower return than in a non-election year. Now, so what does that mean? Does that mean we should change our portfolio? Should we change anything? Or does that mean it's reflecting two of the most volatile periods that we've ever had in an election year, which are 2000 and 2008? So does everyone remember what happened in 2000? And we've had Frank's answered the first two. Does someone else want to answer the third one? Or does Frank want to answer that one as well? What happened in 2000? Why was there volatility in 2000?
Well, there was an anticipation of some stuff as the century turned.
Y2K, that was part of it. Also,
Yeah.
also .com collapse, right?
Well, and then we had the unpredictability of the election itself, Bush v. Gore, which
Right.
muddled things up for a couple of months.
Yep. Yeah, 2000 had all kinds of things going on. I think the big one that occurred in 2000 that caused the market to decline as much as it did and caused a lot of that volatility early was the market, itself, was the .com collapse. But then later, come November, a lot had to do with the election itself and the fact that we didn't know what was coming. But the point here is those two, 2000 and 2008, were really big down years, neither of which had much to do with the election, the president. And because you have those two big down years, it drags the return down, that average return down for election years to that 5.8% number. If you removed one or both of those, you'd see that 5.8 pop back to that 9.6. Again, it's not the election that's driving these returns usually. Now, that's just a quick look at history, and anyone can ask questions at any time throughout this, and we'll stop at the end and I'll stop sharing my screen and we'll have a conversation about it a little bit more. I want to go through these kinds of things. There's difference of policy for both platforms, and we're going to talk about regulation, we're going to talk about trade, we're going to talk about taxes. And as I put this down, I was wondering, what am I going to, what really am I going to talk about here? And there's two stories. Trump has never had a plan. He came in and it's just been chaos and conspiracy theory, random, we have to reduce regulation. He didn't really have a plan on which regulations we had to reduce. We had to actually, take the economy into consideration and for any new regulation, but we were going to definitely reduce regulation. There wasn't a plan. It was always marked by unpredictability. It was always marked by lots of questions and lots of nationalism and so there's no plan. On the other side, we have a plan. We have policies that are coming out that people are wanting to pay attention to that may actually may provide some real benefits. We have ideas about things to do with trade. We have ideas about things to do with climate change. You make some green investments. We've got idea about writing race and criminal justice reforms. We've got ideas about more diversity and inclusion across things. We've got ideas about policing. We've got ideas about criminal justice reform. We've got all these things that Biden is talking about. There's a plan. There's something in place that we can appreciate and move towards. So the reason I put it this way is because markets hate just random volatility. Markets like knowing what the rules are. Under Trump, no one knows what the rules are. Under Biden, they may not be the most pro-business rules. I have no problem with that, but we know what the rules are. It's not going to be randomly changed. We're not going to pick on specific companies. We're going to say, here's the rules. We're going to raise some taxes. We're going to invest a whole bunch in infrastructure. We know what's coming. And so businesses and entrepreneurs can actually think about that and make plans going forward. David, I see you've unmuted yourself. What would you like to add?
Yeah, he also has a healthcare plan, which I thought was significant enough to mention.
Yes, of course. I mean, there's a plan for almost every element, rather than just random chaos, which has affected negatively his ability to respond to a virus, has affected negatively his ability to deal with our allies, has affected negatively his ability to do anything. And people say, well, but he made these tax cuts and that's been really good for business. The markets would have been going up regardless of the tax cuts. Would have been going up because that's kind of what markets do. Markets have a long-term trend. They bounce around that trend, and he gave us a big bonus in those tax cuts. But then he's cost us a whole bunch in this other randomness and the nationalism and the battling with our allies. And we'll talk about this right here, specifically about trade. Now, Biden is going to return us to a global being part of a global community. He's going to look at leadership rather than basically battling all of our allies to see who can get the best deal on a trade policy. He recognizes that in order for U.S. companies to do really well abroad, that we have to actually have trading partners. We can't just alienate everybody. He's not going to be an antagonist every step of the way. This is really, really positive for business. So yes, taxes are going to go up, but the antagonism is going to go down and the rules are going to be clear. And when the rules are clear and that antagonism is down, businesses can be more successful. And that's when we're investing in the business and the economy, and individuals are going to be more successful. There's going to be more support for people. The assumption is very soon after, we hope, Biden is elected, we're going to see more support for people that can't go to work. We're going to see more support for small businesses. We're going to see all the things that have been stalled and canceled because of the antagonism are going to come right back. And that's going to be a huge positive for the economy, for the individuals that are participating in the economy, for the small businesses that are participating in the economy. Okay. Now I want to talk about some specifics here. Trump talks about making some of the things permanent. He talks about maybe an additional 10% middle tax cut, maybe index capital gains, and then beyond that, it's just raising taxes is bad, raising taxes is bad, raising taxes is bad. And it's an age-old story. Biden is talking about, okay, we're going to leave the tax cuts in place for most people. We're going to remove the cuts that were given to those people who make over $400,000. We're going to remove that qualified business interest deduction. We're going to add an additional FICA tax for people that make $400,000 or more. We're going to remove the state tax deduction, which really, when you think about the removal of the state tax, the $10,000 state tax deduction cap, when we remove that cap and move that 37% back to 39.6, those two cancel each other out a little bit, especially on the coasts. We're going to remove capital gains preference for anyone that makes over $1 million. So these are all very, very, very targeted to folks that are making 400,000 plus. And it gets more targeted the more people make, which means the tax code will be more progressive. Now, going in, one could see how if you were making $1 million a year, that would be upsetting. The second thing, though, that he's going to do is he's going to spend, and depending on which analysis you look at, somewhere around $7 trillion on infrastructure programs, on improvements for climate change, on healthcare, on education. And all that spending is going to boost economic growth. And so if you are engaged, if you're someone that's making $400,000 a year or $1 million a year, you have assets. And all that growth is going to boost the assets you have. And this is that trade-off. This makes a lot of sense to me. It hasn't always made a lot of sense to me, but given what we've seen Trump do, I think it makes a lot of sense. The things that I'm not sure of, the things that I don't know that we'll ever see, are things like this elimination of the 1031 real estate tax exchange for real estate. I'm not sure we'll ever see the 15% tax on companies reporting 100 million or more in income. I'm not sure that that's something we can actually make happen. That would overrule the deductions for investing, and that doesn't necessarily make sense to me. I'm not sure we'll ever see a removed stepped up basis. They talk about it a lot. I'm not sure we'll see that because it's almost impossible. When my parents die, I won't really know what they paid for stuff, and I'm not going to be able to trace that. I'm not going to be able to find that very easily. So it's very difficult to do that. All of those things I think it's 5 trillion in new taxes over the next 10 years for 7 trillion in new spending, which that makes sense to me, and I think it's a positive for the economy. But I think there's variables that are outside of the election that are really, really, really important for us to remember, and those variables are actually two. One, equity valuations, and two, it's what's going on in the fixed income market. And when we think about the things that are going to move, are going to matter over the next, 1 year, 5 years, 10 years, I think these are the things that are the biggest drivers of our long-term performance. And the first is this. So on the left, you see this is the weight of the top 5 and the top 10 stocks in the S&P 500. Now, you may or may not know what those stocks are, but the top 5 are Apple, Amazon, Facebook, Microsoft, and Google. And the 6th is actually Google, the second shares of Google. So if you add Googles together, they're actually they're in fourth place instead of being 5th and 6th. And those are all 2.5–3.5% of the entire market. And when you get up to Apple, it's like 7.5% of the entire market. So that's a concentration we have not seen. We haven't seen it. It's more concentrated than it was in 2000. It's more concentrated than it was at any point in history. So what does that do? Well, those companies are all growth companies. And so that's why on the right side, we see that, generally growth is expensive now. Value, which is buying more units of earnings or more units of book value per unit of price, value is less expensive. And we have to remember that, especially when you see this chart here on the right, where you see the decline occurred starting in about 2015. So starting in about 2015, ending in about 2018, we actually started our portfolios where they were more tilted towards the US, and we had a little bit more in our growth. And as value has gotten more cheaper and cheaper and cheaper, we've actually tilted away from growth further, and we've tilted away from the US further because it's gotten way more expensive. And let's go here. And so this is important because it's the big spike between, and it starts actually in 2010, but it actually increases starting in 2015, US versus international. We're always trying to find more units of earnings for a lower price, more units of book value for a lower price. And we find that today in value companies and international. So we have an emphasis in our portfolios on value and international. And we kind of have a default emphasis on those things, but we've also always kept this growthy chunk of our portfolio. But in the recent past, we've been reducing the size of that. And the reason is what we just saw on this chart. Like when that concentration gets so high, it's very difficult for those companies to meet that expectation. And so right now there's a massive expectation. And the question is, can they meet that? Or is that just a price thing, or is there value there? And that's hard to determine. We just think there's a lot better opportunities in value and international. And this is a little bit more granular look at the 2 levels of international. So when you have on the left here, you've got emerging markets, and this is price to book, emerging markets versus the S&P 500. You get below that long-term average, and you get, we're about 1 standard deviation away from normal, which is kind of a place where you think you want to buy more emerging markets. And we're more than that when you talk about IFA, when you talk about international developed markets. It's actually 1.5, almost 2 standard deviations below. So it's the volatility is there, and relative volatility between them. And when international gets really, really cheap, you want to own more of that. Now the downside, and this is why I get kind of excited about this today, because the downside is what we've already lived through. We have seen, again, we always have a tilt towards some value. We always are committed to international. Now we have more value and more international than we've ever had. But the downside of always being committed to diversification is when your home market does really, really well, you underperform because you own these other things. But when you continue with that over full market cycles, over all the down and all the up of all the different markets, you end up capturing more and more and more of that upside. And we're sort of setting ourselves up to capture a lot more upside because we have that value focus and the international focus. And we're going to talk about that in just, right, I think it's maybe this next one. So here we mentioned before the low rates as one of the biggest issues we're facing. And this, we have never seen this. We have never seen rates at this level. And when you think about a diversified portfolio, when you think about broadly diversified portfolio, when you think about anyone that has fixed income, and you look at the returns of fixed income from the 1980s to today, the average fixed income return has been about 6 or 7%. Now, when you go to the 40s and look at the average from the 40s to that 1980, that's a low and rising interest rates. Bonds have a much harder time of even keeping up with inflation because they're, as rates go up, bond values go down. And while you're getting higher rates, all the stuff you owned before is losing. So right now in the fixed income market, we're in a place where not only are we getting 0.7% for our safe money, which is a return that we've never seen before. It's really, really incredibly low. When we look forward and we think about the potential for inflation rising, that means rates are going to go up to combat that inflation. And if rates go up to combat that inflation, that means we'll be losing money in our fixed income portfolios. Slowly, not like you lose money in equities, but it makes the addition of fixed income in a portfolio much more painful long-term. So if we're thinking about long-term returns being in the 8 or 9% range in a normal scenario, and now fixed income provides half of what it provided in the past, you actually have to adjust your long-term expectations to maybe it's going to be 7 or 8 instead of 8 or 9, or 6 or 7 instead of 8 or 9. We don't know how fast the fixed income market, corrects. We don't know how fast. There's no normal. We don't know how fast we see rates go up. And so that's the question. We can't know what that future diversified portfolio return might look like. And for us, this is a much bigger issue than what's going on with the presidential election. And this is what it looks like when you compare these two different periods. What we see on the left is we see from 1940 to 1979. This is from that low point in rates to the high point in rates. And then we see 1980 to today, where we saw a high point in rates to a low point in rates. And what you see in this chart is you see cash, US bonds, inflation, and US stocks. And this is the average returns over those periods. And I think what should be very, very clear is what we've just gone through has been incredible for the US bonds. In fact, US bonds have provided a return over and above inflation, over and above cash. Whereas if you look at it in a rising rate environment, bonds don't provide half the return, provide less return than inflation, where stocks stay pretty consistent. It's the volatility is the problem with the stocks. So what this means is, from a long-term perspective, we have to think about how we're going to create the same levels of returns. And the only real way to create the same levels of returns is to increase the exposure to equities. So the question becomes, given valuations, where do you want to increase the exposure to equities? And it's not the US markets, it's actually international markets. And if you're going to do it in the US, and to the extent you want to be exposed to the US, you want to be exposed in smaller places and smaller companies, not at the top end of the S&P that has already seen that upside. And I hope that makes sense in terms of the big picture planning. And I want to ask and see if either Scott or David or John or Gail or anyone else has anything they want to add to what we've just gone through here.
I think it's worth mentioning around the bonds and interest rates, what happened when Greenspan rose rates a half a dozen times in '94, and what happens to bonds when rates go up like that. And that is, you actually lose money. And I think a lot of us were brought up at the dinner table, stocks risky and bad, bonds safe and conservative. And I think there's some merit to some of that. But when you have rates this low, they can only go up over time. There's this unspoken rule out there that I think a lot of investors and families believe bonds are safe and they can't lose money. And if we have anything resembling a rate hiking cycle like happened in '94 when he rose it a half a dozen times, second half of '94, that's the equivalent of going from, like what Jonathan was saying, 0.75% to like 3% in the same year. That kind of move. Rates go up, bond prices go down. So I think there's a real lack of awareness out there that this is coming at some point. I don't think it's tomorrow. I don't think our firm thinks it's tomorrow, but rates aren't staying here forever. So just be aware of that. And so it gets bonds at this point in juncture, as far as portfolio construction are concerned, no one's investing in bonds for rates of return anymore. There are no rates of return. It's really there for ballast and dull the volatility and to make the ride a little bit, instead of it's a little bit smoother. That's what we're using bonds for these days. So yeah, rates are in a very interesting place, to say the least.
Sure. Yeah, and it's actually more what's the right word? Nefarious than that, because if you look at where money is being added, so since earlier this year, and this happens every time you see a market dislocation like the one that was related to COVID in February and March, you see money get pulled out of stocks and it goes into fixed income because it's seeking safety. And over the last 10 years, or maybe 7 to 10 years, as we've seen rates tick down, people have stretched their risk tolerances in order to get some return for their fixed income. So people that used to be only investing in like high quality fixed income, they've said, okay, I'm going to add some REITs to this, or I'm going to add some junk bonds, or some shorter term fixed income that might give you some yield. They've added some credit. They've added things, and the people that were investing in credit or investing in junk bonds before, in order to get that yield, they've actually said, you know what, I'm going to have a little bit higher equity exposure. And every time you see a dislocation, then everyone runs for the hills. And there's a point here where we've gotten safer and safer and safer and safer and safer. And the thing that Scott's talking about, the safe thing, the thing that we've gone to because we were afraid, is now the thing that's the highest risk. Now it's never going to be a situation where the bond market, well, it's possible. I can't say never, but it's not like the bond market is a kind of place where you're going to lose 20 or 30%, unless you're, high yield and long duration. But if you're not going to lose 20, 30%, then you can still lose 10 or 15 in the Barclays Ag, which by itself will cause all the people that thought that they were safe and have moved to those money to fixed income to never engage markets again. Obviously, if they're losing money in fixed income, markets are broken, right? That is the response. The response is to run away from the pain of a declining market, not engage when you should, not rebalance and buy more, and seek safety. And Wall Street over the last 10 years, ever since, well, now this year, especially since COVID, you're seeing a lot more products that say, you know what, we're going to give you slightly less than market returns for low risk. And every time those products come out, you've got to know that the companies that are manufacturing those things are making a bunch of money on it. It is not realistic to expect market returns without market volatility. Those two things don't exist.
So a question did come in. Are we expecting interest rates to remain low until we're in a post-pandemic era? So thanks for that question, Frank. That just came in.
I think until post-pandemic. So the reality is, pandemic is going to, I think I've heard all kinds of different numbers, but end of 2021, it's not, the pandemic is not going to be over necessarily. Okay, I'm already getting head shaking, but there's going to be people with vaccines. 2022. Okay, Alexa says 2022, but it's a short-term thing, regardless of if it's late 2020, 2021, or 2022. It's a short-term thing. So I think it's reasonable to expect that interest rates remain low in the short term. I'm still holding out. I got to tell you, I've had my marker on 2% 15-year, and I've got my mortgage broker is waiting for 2% on a 15-year mortgage. And I'm waiting. It's been sitting, it's been hovering at 2.1, 2.07. That's fine. I want 2%, and we're going to refinance when I get there. I think I'll get it. So Frank, to answer the question, I do think rates will come down a little bit more. I do think it'll stay here for a while, but I don't think we can rely on them staying here for long, given the amount of money we're spending. I think the reality is, and it's global, this is a global issue. To get through the pandemic, we're going to spend a lot of money. When Biden is elected, and I'm saying that I don't know that that's going to happen, but I'm hopeful. So when Biden is elected, then we're going to see a lot of things that should have happened in the last year happen. That's going to be expensive. To do that, to spend that money, is inflationary. It is. There's no question that we will see inflation come out of it. I'm not predicting hyperinflation. I'm not predicting anything that's bad, but we'll see higher rates because of that. And those higher rates probably are 3, 4, 5 years out. And then the thing that follows on higher rates is going to be a big battle over reducing government spending. Because remember, now we're going to have so much debt that higher rates are going to hurt. They're going to crowd out other government spending. So we're going to have a big battle about how that happens. And you're going to see modern monetary theory come back. You're going to see all kinds of conversations come back around that. Great question, though. I think that's one of the questions that's important to think about is how long can we expect rates to stay low? And then what happens as rates rise?
So one thing to add on to that, and just like Janet Yellen before him and Bernanke and Greenspan before them, Jerome Powell's been out, Federal Open Market Committee, and has been pretty clear. And I think he's been more transparent than anyone that I've seen in the last couple of decades, which is good because the market doesn't like surprises. And he's just come out recently, I'd say in the last 30, 60, 90 days, and pretty clear. And that is he doesn't anticipate raising rates till 2023. And so I don't know that he puts that language out there unless that's what he believes. So there's time before rates go up. So anyone that's motivating you as a lender or realtor, you got to buy, you got to lock in this loan tomorrow, rates are going to move. I think that's disingenuous in the true landscape of what's really going on right now. Yeah,
for sure. I think he said, we're not even thinking about raising rates. Right. That was his quote, and not even approaching it. Are there any other questions? I've been blabbing. I put a lot of stuff out there. We focus on value, focus on small companies. I think that's international. I think there's a lot of value there still. Scott brought it up earlier. When we launched this thing, that one of the things we have to keep reminding people is because we're broadly diversified, because we're not just in the, we're not concentrated in 10 companies. We're not concentrated in the S&P 500. We are actually targeting expected returns. The more concentrated you get, the more you're actually hoping for unexpected returns. The more you're hoping for something to go your way that no one saw coming. But we're actually owning 12,000 companies across our portfolios, and because we do that, we're just trying to get expected returns. And those can come from U.S. markets, international markets, big companies, small companies. Doesn't matter. We're constantly rebalancing towards value. We're constantly rebalancing towards small. We're constantly rebalancing towards things that right now still have upside. I don't have a slide for this, but someone asked the question, I think this maybe 10 days ago, and they were asking about valuation, and they said, well, Jonathan, you've quoted this Shiller thing before, this 10-year cyclically adjusted PE ratio that Shiller runs. And by the way, it's been overvalued forever. It's always overvalued, but right now it's at a unique place. It's cyclically adjusted. It's at 32. It's above what it was in the .com. But that is just the S&P. He's looking at the 500 biggest companies. There's another group, very well respected. It's called Morningstar. And Morningstar looks at the global equity market. And they're saying that the overvaluation is about 8% overvalued, because they're not looking at one subset of companies. They're looking at all the companies. And so what that differential to me is important, because we don't invest specifically in what Shiller is talking about. In fact, we don't invest in specifically what Morningstar talks about. If you took what Morningstar does and you subtracted what Shiller does, what Shiller's talking about, we invest in the remainder. We invest tilted towards value, tilted towards small, tilted towards international, where all the value resides in the markets. So if Morningstar is right and the global market is 8% overvalued, we're actually investing in the parts of the global market that are undervalued, right? So we have a much, again, we're not going to knock the ball out of the park. We're going to hit singles and doubles. We're going to keep doing that and repeat that process until our clients and our goals are met. That's the process of investing that Warren Buffett and Benjamin Graham and the brilliant folks out there that are investing. That's the process that we use, is how do we protect capital and make some money at the same time while protecting capital, and that's our goal. So here's another question came in. What about the old adage that the market prefers divided government between Republican and Democrats rather than one party in complete power? I think so. It's interesting. I think we kind of talked about this earlier in a team meeting, or maybe it was just David and Scott and I talking before this. So yes, the markets prefer divided government. However, I think that the reason for that is because you don't get any massive shifts. I think we're at a unique place in time, not just because Trump was president, but because the parties themselves, the individual parties themselves, are not monolithic, right? So Republicans don't agree, neither do Democrats agree. They're clear that they disagree with each other, but internally there's also a lot of disagreement. There's a lot of disagreement about how to provide healthcare for everybody within the Democratic Party, and I think that maybe that the ballast within the Democratic Party is enough control for the market today. I think that we're looking forward to having problems solved, having a plan, and moving forward, and maybe the resultants of having a little bit less inequality built into this whole thing is at the same time. I think there's a lot of positive that's going to come out of a blue sweep, or a blue wave that they're calling it this time. And I don't think the market's afraid of that. In fact, Goldman Sachs, as David suggested earlier, Goldman Sachs came out and said two things. They said, one, this isn't going to be as contested as people say. There's going to be enough votes. It's going to be clear. It's going to be clearer more quickly than expected. And this is Goldman Sachs talking to their clients. We actually prefer a Biden outcome. So this is the big money. This is Goldman Sachs saying it's not going to be bad for markets if there's a blue wave, if there's a blue sweep. By the way, I was on a call with Jamie Dimon, with Tim Kelly. What's his first name? David Kelly. Thank you. JP Morgan, David Kelly. And he said the same thing. Their base case is Biden wins, blue wave in the Senate, and that's the expectation, and they're actually happy with that.
Well, the expectation is that the Democratic plan will be more robust for the economy's growth than the Trump
lack of plan.
Trump doesn't really have a plan, but kind of more of the same.
Yeah. Yep. And the cost falls to those people who are doing really, really well. And much of the benefit will also fall to them. So I think that there's something positive that comes out of that. And maybe as a culture, we move more towards that, realizing, 4 years later, we go into election, we've had a return to much faster growth because we've invested in our economy. We've had a return to faster growth because we've invested in education. We've had a return to faster growth because we've invested in our healthcare system. And by doing that, we'll actually maybe say, oh, and my taxes were higher, but I made more money in markets. I did better here. I did better. So there's a lot of positive that can come out of this. And I'm actually looking forward to that. I think that that's probably the highest probability outcome that we see going forward. Dave, do you have something else to add?
Well, I would only add that progressive taxation worked very well in the mid 20th century. Basically, we started a trend from Reagan on toward, reducing taxation, particularly at the top, and it's led to the kind of extreme imbalance that we have today. So there are ways to make taxes make the overall community better, and I think we have to return to that.
Yeah, I think they talk about the pendulum swinging, and we've just swung wickedly one way, and so now we'll swing back the other way, and that makes sense.
Well, this is like the Gilded Age before Teddy Roosevelt. We're kind of reliving that. So.
Yep, for sure. John, you have anything to say? I heard you laugh, which usually means you're off mute. So what do you have to add there?
Well, when the Spanish flu, or what was it? The Spanish, was it the Spanish flu?
In 1918, yeah.
What happened right after that?
Well, we had the Roaring 20s right after that.
Yeah. And that ended well.
Yeah.
Not particularly.
We had a great 10 years before the Great Depression.
Any words of wisdom for our participants if Biden doesn't win?
I think that the key in the first 7 or 8 slides is that for our economy and markets, the businesses involved, it doesn't matter in the aggregate. In the aggregate, it doesn't matter. Markets are going to go up 3 of the next 4 years, regardless of who's elected. But that's markets.
What about the emotions, though?
Yeah,
what about the emotions? That's really what it's all about. Because the numbers have been proven.
Yep.
But the emotional reaction could be devastating for many people.
But I think the devastation does not come relative to the economic issues. It's more to do with the integrity of our democracy. So, I think those are a bunch of separate issues. The market is probably would continue to go on and increase, but there are other maybe more important conditions of life that wouldn't be so good.
Well, I do know that when Trump won, both Jonathan and I were in this office at 6:30 in the morning fielding phone calls. So
everyone
that was real.
It was tears. I mean, it was tears across the board. Every single person we talked to, people came into the office crying. It was miserable. And it would be, if that happens,
it'll be worse this time.
It'll be worse. No question.
But let's quantify what happened. I think would be helpful, right? So you had an election in November. You had the market drop 2,000 points in the next several weeks because of what happened. And if you decided to get scared, go to Canada or every other version of what we were hearing from people, the market went from 15.9, call it 16,000, to 25,000 in the next 2 years. So it had that initial drop after several weeks of the election, and then it all gets down to earnings and companies and economy. And it's not Syria. This isn't Venezuela. One guy does not destroy a $19 trillion economy. And it's so important we remind everybody of that.
It's for us. I think that John's question is we're gonna field emotional calls, and our goal when we feel those emotional calls will be to separate the emotions from the likely economic and market outcomes, and share in those emotions, whether we're excited or whether we're depressed. We're going to share that emotion with the vast majority of our clients. Feel the same way, and then make good decisions. How do we feel that? Yeah, that's real. And then set that aside. And then how do we make really good decisions so that our family's goals, our retirement goals, our things can be met? because the two things don't play well together. Voting with your dollars, voting with your investing dollars based on your political beliefs or outcomes or fears, or it just doesn't, it never works the way we think. There's two really good examples of that in the very recent past. One would have thought that given a Trump election, that one of the best companies we would have seen out there would have been ExxonMobil. Exxon has been cut in half. It's been one of the worst performers we've seen in the last 4 years. At the same time, post Trump election, one would have thought that Elon Musk's Tesla would have been crushed because they removed the subsidies. They removed a lot of the money that was going to support alternative energy and alternative energy vehicles. And guess what? It's one of the best performing companies out there. So had we acted based on our expectation, based on an election, that could have really hurt us. And so it's best to recognize in those moments that this too shall pass.
So question,
Well, you can move to Canada, but keep your portfolio.
Yeah, you can.
a couple of questions came in. Are there any business or other cases that are in front of or may come before a shifted Supreme Court that will have major impacts on the economy? Question number one.
That's a fantastic. I don't know of anything. I think that what's happening right now isn't a short-term play. It's not something's coming up and we're going to try to stack the court. They're recognizing that Republicans are, look at the next generation, look at the millennials. They aren't Republicans, by and large. And so they're recognizing that they're losing power and they're trying to create a system to maintain some kind of a conservative thing going on for the next 50, 60 years. That's the goal. I don't think it's anything that's in front of them right now. The one that's in front of them right now,
The ACA is in front of them right now.
ACA, Roe v.
could
Wade.
have-
ACA, Roe v. Wade. Those are the two things that are going to come out the most quickly.
Well, there's a case in November with regard to the ACA.
Yep.
And that could have, a significant effect on the economy if all
How
these
so?
people lose their health insurance.
I mean, a significant effect on the economy, that seems a little aggressive.
Well, I think it would just deepen what's already going on. I mean, we have millions of people who are continuing to be unemployed and to
Yeah.
fall closer and closer to the poverty level. If the Supreme Court were to strike down the ACA, it's only going to increase that impact. It's not going to take the entire economy down, but it will have some negative impact.
It'll be a little negative. I agree.
Regardless of who's elected, one of the things to remember, and I see there's another question there, but one of the things to remember is regardless of who's elected, the next 6 months is going to be filled with news about vaccines. And that news will lead us towards that. Remember, what do we say? There's a slump, a bounce, a crawl, then a surge. When we have all the news about the vaccines, all the positive will be surge creating. So markets will go up because of the news about the vaccine. And ultimately and maybe none of them work. Maybe we got to go back to the drawing board and create a different one. There will eventually be a vaccine for this. And right now there are five, right? In stage 3 trials. There's a lot of conversation about, that what was it? The AstraZeneca one was paused. And if it wasn't a COVID vaccine, no one would ever know that it was paused. The vaccines are paused all the time. It's part of the process. And we panic and freak out about it. But the only reason we panic and freak out about it is because now we know, because we're all paying such hyper attention to it. So eventually we have it. There's going to be a vaccine. Between now and then, there will be a slow crawl getting better. We didn't talk about it this time, but all the high frequency data, it's slower than it was 2 weeks ago, but it's way better than it was 2 months ago. All the things are getting better. More people are eating out. More people are flying. Scott, what was the number of TSA today?
Over 1 million for the first time since March, this Sunday. So yesterday, travel.
Do you remember what it was in January? Is it 2 million? How far off the top are we?
I think it's about 2.5 million. So it's still not quite halfway back, but it was It was at like under 100,000 in March.
Right, exactly. So,
And it's steadily improving.
right. And but it's not a straight line. Like it improves and it has a bad week and it has a better week and has a bad week. And that's, we should expect that. So all that's happening while the election is happening. And so what the things David was talking about, yes, it could have a negative impact, but other things are having a positive impact. Now this is a good question just came in. If Biden wins and there's civil unrest from far right groups leading to violence, destruction, business cities, increased government spending, bringing in military, what could that impact the economy markets? And without saying that that's not going to happen, because I don't know, it seems a low probability thing. What is it? What's the group called that Trump always calls on, the stay ready or stand by or whatever? Proud Boys. You can't say that they're not going to, show up with weapons on doorsteps. You can't say that, but they're not allowed to everywhere. There's a lot of places where you're not allowed to carry a gun. It's not, open carry is not a thing. A lot of places where it is allowed. You'll see the photographs on the media that come from the places where it's allowed, but it's not allowed in most places. And the U.S. military is not a fan of Trump. So if the U.S. military is called upon, they're going to be on the side of the winner, which we hope is Biden. But I'm not as worried about, massive violent uprising because Trump loses. I'm not. That's not a base case. If Trump loses and he loses by a wide margin, I think remember Y2K? It was the end of the world. It was nothing was going to work. The computers were all going to fail, and that is what media does with this story. And they talk about how bad it could be, and it could be the worst thing in the world, and it could be, but that's not the high probability. The high probability is Biden wins, Trump is dismissed from the office, end of story. That's the highest probability outcome here, and I'm gonna operate based on that probability, that high probability outcome. Scott, you wanted to add to that? I saw you nod and open your mouth a little bit.
Well, no, I mean, I think even if the question is around some of the violence we saw, we have a little bit of history and evidence to look at what just happened. Maybe some cities go through that. Maybe that does happen, but it's not a permanent condition.
And it's not widespread.
No, and if you just look out 12, 18 months from now, the election will be over. If there is violence, that'll be over. And we'll get on to doing what this country does best, which is innovate and grow and expand and hopefully take care of everybody. Cross our fingers.
Be more inclusive. Like we will, I think the biggest change we're going to see is we're going to have a much more inclusive society, and I think that comes regardless. I mean, even if Trump wins, I think we're tilting in that direction anyways. And we could see this really big surprise if Trump wins. We could actually see a really big spending plan, because now he has a chance. So David shakes his head. I remember when Obama was elected, it was like everyone said, well, if Obama was elected, we're all going to pull out of the Middle East. And I saw one guy who presented, what's going to happen if Obama's elected is we're going to go in stronger than we were before. And that's exactly what happened. And you don't expect it. You don't expect Trump to do that. But it's at least possible, because then he'll have a way. He wants us to remember him positively, guaranteed. Now, how do we do that? I don't know. You may see, no, everyone disagrees. We'll see. Let's hope we don't see. Let's hope Biden wins and we won't have to have this conversation. Thank you, everybody. You've been here an hour. You've dealt with us, asked some good questions. I'm happy to hang out for a little bit longer if people have other questions, but thanks for coming and asking good questions.
Thank you. Stay safe.